So, welcome to this class on case analysis continued again. See, we looked at the different ratios in the last two classes. What are the ratios which we should consider for analyzing a case? We first went from how do we develop a case, how do we analyze a case, then what is the objectives of the case method, then what is the benefits of the case method, then how do we develop a case, then we looked at what are the ratios that we should consider in when we are analyzing a case. So, when we were doing that, we also considered what are the types of what are the measures of financial performance. In these measures of financial performance, we looked at the measures of corporate performance, how it is calculated. Then we looked at what are the stakeholder measures. So, we gave a sample scorecard for keeping score with stakeholders. Then we looked at the summary of the key financial ratios. In particular, we looked at the profitability ratios. The profitability ratios can be listed as gross profit margin, operating profit margin, net profit margin, then the return on total assets, then the return on stockholders equity, then the return on common equity, then the earnings per share. We looked at the leverage ratios. We also looked at the liquidity ratios, that is the current ratio, the quick ratio, the inventory to working capital. Then we came to the leverage ratios. In the leverage ratios, we looked at debt to assets, debt to equity, long term debt to equity ratio, then the times interest earned, then the fixed charge coverage. We also looked at activity ratios. Here we looked at inventory turnover, fixed assets turnover, then the accounts receivable turnover, then the average collection period. Before we wind up on the ratios, what are the other ratios which may be of interest while analyzing the performance of a case? Other than what we have already listed, we have looked at all these ratios, that is we have looked at the profitability ratios, we have looked at the liquidity ratios, we have looked at the leverage ratios, we have looked at the activity ratios. Then apart from this, are there other ratios which may be of interest while analyzing a case? There are a few more ratios which one could consider. We will consider 3 or 4 of them which may be of interest while analyzing this, analyzing the performance of a case. So, the other ratios could be the dividend yield on common stock, dividend yield on common stock. How do you calculate the dividend yield on common stock? So, if you look at how to calculate the dividend yield on common stock, we can give the formula for this dividend yield on common stock. Dividend yield on common stock. The formula could be, the formula or the calculating method could be the annual dividends per share, annual dividends per share divided by the current market price per share. So, the dividend yield on common stock, the method of calculation is annual dividends per share divided by the current market price per share. So, what does it give you? It gives you a measure of the returns to the owners received in the form of dividends. So, how much does it pay for you to hold the stock of a company? Suppose you hold the stock of a company, say like Infosys, how much does it pay? So, this is what I was trying to discuss in the previous classes. The current price per share of Infosys is rupees 5. Let us say the company declares 200% dividend, hypothetical. So, what is the price that you have paid for your share? The price in the books of the company per share, it is 5. So, for every 5 rupees share, it is declaring an annual dividend, let us say, of 10 rupees. So, if you held a 5 rupees share, you are getting 10 rupees as dividend. Now, what is the price at which you have purchased the share? You might have purchased that share at 2500 rupees in the market. Then what is the type of yield on common stock that you are getting? So, if you are really looking at that, so if you are going to get some 10 rupees divided by 2500 rupees, that will be the dividend yield on common stock that you are going to have. So, which might be considerably less. So, but this will give you an idea. Suppose there was a person who had purchased the 5 rupees share at 5 rupees only, hypothetical again, and he gets 10 rupees, then what does it make? He makes a neat profit of 100% over his share. Suppose he had 1000 such shares, let us say, he makes 1000 into 5, that is 5000 rupees. So, the whatever money that he invested on the shares, he has gotten back already in 1 year dividend. So, the next year dividends and other things is only profit accumulation. So, this is the way you have to look at the common stock. Then what is meant, the other one which we are looking at is called the price earnings ratio. Price earnings ratio. How do you calculate this price earnings ratio? It is calculated by this current market price per share, current market price per share divided by the after tax earnings, after tax earnings per share. So, suppose your earnings, share earnings cross a particular level, you may have to pay tax to the government. So, after tax earnings per share, what does this give you? It tells you faster growing or less risky firms tend to have higher price earnings ratios than do slower or growing or more risky firms. So, this is a comment which this is something which you should keep in mind. Suppose a firm is growing fast, or suppose the investment in such a firm carries less risk. So, I have given you different examples. Why do you want to invest in a company? So, you can look at the type of risk that you are taking before making an investment in a company. So, faster growing or less risky firms tend to have higher price earnings ratios than do slower growing or more risky firms. Then the other one which we are interested is what is called the dividend payout ratio. Dividend payout ratio. Dividend payout ratio. This is calculated as annual dividends per share divided by after tax EPS, that is earnings per share. So, what does it tell you? It indicates the percentage of profit paid out as dividends. The company might not pay out the full profit as dividends, might keep some portion of the profits. So, it tells how much of the profit is paid out by the company as dividend. Then the other one which one might be interested is what is called the cash flow per share. How do we calculate this? The cash flow per share is calculated by after tax profits plus depreciation divided by the number of common shares outstanding. The number of common shares outstanding. So, cash flow per share is the method of calculation is after tax profits plus the depreciation divided by the number of common shares outstanding. So, what does this tell you? It gives you a measure of the discretionary funds over and above expenses available to the firm. A measure of the discretionary funds over and above expenses available to the firm. What does in other words this ratio give you? This ratio tells you how much money you can command through reserves. Some money you will flow it to the reserves, it is already there in the reserves. Some money you can raise in this current year's performance, flow it back to the reserves. Now, when your reserves go up, what does it tell you? It gives you an idea of how much investment capacity the firm has got. So, this is how you evaluate a firm. So, many times most of these firms say like Infosys. You read statements in the press that Infosys is buying out a firm paying full cash in the United States, which runs to quite a considerable sum, many times millions of dollars. How does it make that payment? It is through the reserves that has been accumulated. So, this type of ratios will give you an idea of how much money the company is able to muster through the reserves, that is the investment capacity of the firm through the reserves. So, this will give, so many times it is always said that keep your reserves position as good as possible. What do you mean by keeping the reserves position as good as possible? The company should be able to draw on the reserves whenever it is required. So, do not have to again go only to financial institutions for lending purposes, then the repayment and all that. So, in fact, if you look at a company like Infosys, it keeps on priding by saying that we have raised the money for our investments fully. So, we are not borrowing. Okay. So, suppose it is an acquisition or any other type of investment, the company says we have paid it from our own reserves, from our own accumulated funds. So, how is it possible? This is an indicator of the performance of the company over the last so many years. Now, these are in short the types of ratios that you should consider to analyze the performance of a company. Now, how do you analyze a case? This is the next. Okay, I gave you all these ratios. I gave you the how you should calculate these ratios. Now, what I am going to give you is an example taken from this book on strategic management. One of the cases, how it is analyzed by two of my students. So, two of my students, how they have analyzed this case. So, I am going to present to you how this case has been analyzed with respect to the questions that have been asked. Okay. Now, the case that I am going to present to you is the case on Infosys only. So, if you really look at the Infosys case, this case is available to you as case study number 6 in the book on strategic management, Infosys Technology Limited, truly global. Now, at the end of this case, I have listed out some issues for discussion. What are the issues that have been listed out for discussion? One is comment on the appropriateness of the models used by Infosys for market delivery. Are they likely to be valid in the next 5 years? Second, what shift in technological businesses should Infosys be looking for? What changes in strategy would you advocate? The third question, the major revenues of Infosys come from the USA. The slowdown of the American economy has led to pressing of panic buttons. What marketing strategy would you prescribe for Infosys to come out unscathed? The fourth question, should Infosys go in for branded products? If yes, what are the steps that you would suggest? The fifth question, should Infosys aim for distinctive competence? If so, what steps would you suggest to achieve this goal? So, in order to do the case analysis of a case like this Infosys or any other case, how would you go about this? This case gives you data maybe up to a certain point of time. So, what you should try to do is whether this case data can be updated. This is the first thing that you should try to look at. That is whether through available sources, maybe through the annual reports of the company, the listed reports of the company, all those types of things, whether through other different sources, whether you can update the data that is already given in the case. Similarly, updation of the information that is provided in the case, not only the data, but also updation of the information that is provided in a case. That will give you a better platform to address the case issues. So, I will just give you the way these case issues have been addressed by one particular two students with respect to this case Infosys. Okay. So, this is if you really see what they have done, the same this thing case study on this Infosys technology, they have given a brief profile of this company Infosys, how it was started. So, started in 81 by Mr. Narayan Murthy and 6 engineers in Pune with an initial capital of US $250. Today, a global leader with revenues of over US dollars 3 billion. This was in 2009. So, when this whole thing is analyzed, now company is even above 4 billion as I understand. So, the defines, designs and delivers technology enabled business solutions. A global consulting and IT services company, Infosys was listed on NASDAQ in 1999. This is the first company, Indian company to be listed in NASDAQ. Now, what do the next slide give you? The next slide gives you Infosys through the years. How has it grown? From 1981, it was trying to catch a foothold in the market. Then the run up from 92 to 99. From 99 onwards, this is the big leap that the company has taken in the software industry. So, getting a foothold, what is the type of strategies that was adopted by the company? It was really working with shackles, command and control economy, import restrictions, punitive taxes, underdeveloped capital markets, foreign exchange controls, then capital shortage for infrastructure investments, then the poor telecom infrastructure. Then what are the types of strategies the company adopted? It focused on on-site jobs, few large customers, indirect sales. So, this is the way the company went about in this stage of foothold. What about the run-up stage? So, the run-up stage characterized the liberalization of the economy. So, what we saw during that time was the abolition of licenses, rationalization of taxes, then the export incentives, then the rationalization of tariffs, then abolishing of wealth tax on productive tax assets, then foreign exchange reforms, then free pricing of issues and entry of foreign FIIs, foreign institutional investors, then the employee stock option plans. Now, what did the company do in this stage? The company went in for global benchmarking, the global delivery model. The first time a company gave such a type of model, it is given in detail in the book also. What does it tell you? Do work where it makes economic sense and reduce the total cost of ownership. Then use 2 working shifts in the same calendar day to reduce time to market. What does it mean? Suppose between US and India there is this time difference. If it is night here, it will be day there. If it is day here, it will be night there. So, for a US job, it might be advantageous to make use of this time shifts. So, some of the people will have to work who are working on this US projects in the night to cater to these US clients. So, this is the type of strategy which the company adopted. Now, most of the companies do have adopted this. Then ramp up resources in multiple continents, employee retention, investment in sales and marketing, becoming a company of choice for investors and employees. Now, the third stage, that is this big leap. This is the current environment. What does it tell you? The market trends, what does it say? Points to globalization, deregulation and consolidation. These are changing business fundamentally. Then financial markets have been transformed. Then there is increasing competition from low cost economies. Then what about the technology trends? You have got this high speed ADSL and optical fiber, they are providing higher bandwidth. Then wireless access and new technologies like WAP and Bluetooth are becoming popular. Then web appliances are expected to proliferate and non-PC devices will outnumber connected PCs in the future. This is the type of trend which is anticipated. Then what is the outsourcing trend? It is increasing. Why is it increasing? Because of the time to market considerations, internal resource shortage, then the cost control, then the complexity of IT, then the improved vendor capabilities, then the focus on the core competency. So, this is what I was trying to tell you in the earlier classes also. It is always advantageous for a firm to devote more attention to where its core competency lies. For example, take ITI. The core competency of ITI is in the production of telecommunication equipment. So, this core competency of ITI, it should convert it to competitive advantage in the marketplace and if possible to distinctive competitive advantage further. What do you mean by distinctive competitive advantage? It becomes difficult for the competitors to imitate this product which is put out by ITI. As long as it is not possible for the competitors, that will serve as a distinct competitive advantage for distinct sustainable competitive advantage for the firm ITI with respect to that particular product or product line. So, the same way with respect to any firm. So, this is the way if you look at it, the Infosys has really looked at that, gone through the different phases, and now if you really see what did Mr. Murthy try to do in 98-99, he planned to position Infosys as a true global company. He looked at three features of global strategy, that is a global delivery model, producing where it is most cost effective and selling where it is most profitable. Then the second feature was to move up the value chain, that is getting involved in a software development project at the earliest stage of its life cycle. And the company is now looking at the PSPD model, that is the predictability of revenue, sustainability of the prediction, then the profitability of revenues and re-risking. This is the type which the company is operating right now. So, now what is the type of financials? What have these students tried to do? They have looked at the financials or the financial results of the company. This is if you look at Infosys, it gives you according to the accounting practices followed in India, the financial ratios or the financial indicators, which we discussed in great detail till in the last few classes. It also gives you the accounting, the financials as per the American accounting standards also. So, what this slide presents to you is looking at the financials from the Indian GAAP, that is the general accepted accounting practices, which is from the Indian side. So, this is they give you also US dollar million, how much has the company made. So, what have these people done? They have gone up to 2009, this is what I just told you. So, whereas the data that is presented in the book goes up to 2006, sometimes a little beyond. What these two students have done is to take the data further. They have taken it further up to 2009. Now, what does it do for them? It helps them to focus their answers better with respect to the issues. It gives them a more or less current picture of the organization, and that current picture of the organization helps them to answer the issues better. So, it is better for you also to update the data given in the cases to the extent that it is possible. Sometimes it might have gone up to 2007 already, find out you can whether you can go up to 2010, we are already in 2010, whether you can get this data in up to 2010 updated. All this will help you to answer the cases, issues that are given in the case. Sometimes the issues that have been listed for discussion, some of them might not be relevant. At that time this a case was listed, that issue might have been there. Now, as the years have rolled by, the company might have overcome that issue, and that issue might have become irrelevant. For example, let us say a company. So, to be to present you a factual picture, a company like ACE Designers, it wanted to achieve a particular sales target by a particular year. Now, one of the issues which was listed for discussion when a student was analyzing that particular case on ACE Designers, this is ACE Designers is a company which is into machine tools, especially the CNC machine tools. So, this is it has got its markets both within the country and also abroad, has got especially in the United States, has got subsidiary firms also in the United States doing well. So, it wanted to achieve a certain targets by a particular year. So, that used to be listed, that was a vision of ACE Designers, that used to be listed as an issue for discussion for the students. Will the company be able to achieve this vision? Now, what is the position now? That issue itself has become irrelevant, because the company has outstripped or achieved this target much ahead. Okay. So, no need for looking at that particular issue right now. So, this is how cases also go, case issues also undergo lot of transformations. Now, if you really see, this is the students have analyzed the income of Infosys going from 2000 to 2009. So, then in rupees crores, then the profit, operational profit, profit before interest, depreciation and taxes, how has it gone? So, if you really see, there is an increasing trend which you are observing from 2000 to 2009. Then what about the earnings per share? A very increasing trend which is going up. So, if you see from 2000 to 2009, it is a more than 100% increase in earnings per share. What about the book value per share, that is in the books of the company? Again has recorded a healthy increase. It's gone up by 310%. That means what was it has gone up by if you really see the basic earnings per share, it was 5.41 in 2000, in 2009 it is 101.65, whereas in 2000 the book value per share was 15.75. In 2009 this 5 rupee share book value is listed at 310.90. So, this is the way the company itself is listing. So, if what is the profit for after tax, again in it has gone up, you see a very high increasing trend. And similarly, if you look at market capitalization, you see some changes taking place. So, it has from 2008 and 2009, that is the period when the 10 rupee share was split into 5 rupees and you got more number of shares put into this. Then the operating profit or the to total revenue again gone up, then the profit after tax to total revenue, then the return on capital employed, how has it gone up? This is reflected on this. Then this slide gives you the cash and equivalents to total assets, then the total output ratio, then the value added per total revenue in percentage. Then what is the basic earnings per share already given to you. In 2001 it earned 101.65. What is the dividend per share? It is 23.50 for a 5 rupee share in 2009, that means more than 400% or nearing 500%. What is the price per earning at the end of the year? So, in 2009 it was around 13.02, slightly you see the dip from 2007 to 2008 to 2009. Now, the 2000 gross profit margin, how was it really? Here is a slide which compares Infosys, TCS and Wipro. How have they really performed? So, this is what is expected of you also. So, when you are looking at an industry, say this is a software industry. So, these are three majors of the Indian software industry. How have they performed? If you look at Infosys in 2009, performed better compared to TCS and Wipro. Similarly, in 2008 also better. If you look at 2007, TCS has performed slightly better. In 2006, again TCS has performed better. In 2005 also TCS has performed better. So, what does it indicate to you? Between 2008 from 2008, the performance of Infosys compared to the other two majors, that is TCS and Wipro, it is recording a higher gross profit compared to them. So, this is the way one analysis. Similarly, operating profit, if you really see, operating profit of Infosys always higher compared to TCS and Wipro. So, whether it was 2005, 6, 7, 8 or 9. Now, what does it mean? Whereas in some of the years in gross profit, whereas in 2005, 6 and 7, the gross profit of TCS and Wipro was a little higher compared to Infosys, but when it came to the operating profit margin, again Infosys has gone ahead of the other two majors. So, if you come to the next one, that is a net sales, how does it compare? If you really look at it, in 2009, look at the net sales. TCS always recording a higher net sales, always and when you look at the current ratios with respect to Infosys always higher compared to the other two firms. What does it mean? So, current assets by current liabilities. So, its assets are much higher than the liabilities. So, it can pay off at any point of time. That is what I told you. It is always the more money that you have to pay off your debts or to make investments, that is the reserve positions, it always helps a company to have a very strong hold in the market. So, this is one of the reasons why the share movement of Infosys in a stock market like BSE again provides indicators. So, whenever the stock BSE index goes up, you also find that one of the gainers of this index or one of the companies which has moved the BSE also to go up by its steady performance happens to be Infosys. So, whenever its results are announced, you find that there has invariably been an increase in the BSE index, showing that it is reflecting positively on the stock market. Okay. So, this is the way it is. Now, the next one which is brought out is the Infosys vis-a-vis the peers. So, again tells you about detailed risk management reporting. Infosys, if you see, tells what is the risk that is involved with respect to the different investments. So, TCS does not give you full details, similarly Wipro does not give you full details. Corporate governance report, all the companies give you. Then the detailed subsidiary information, Infosys provides full information, TCS does not, Wipro does not. Then the value reporting, how much value the company made per employee or whatever, that is also reported by Infosys, but TCS and Wipro no. The intangible assets score sheets again reported by Infosys, not by TCS and Wipro. Similarly, the human resource valuation, the economic value added information and the brand valuation, all these are reported by Infosys. So, this is there is a human resource valuation model which Infosys uses. This is all this coming under this corporate social governance or the corporate social responsibility, all this. So, uses the Lev and Schwartz model to value its human resources. What does it help? What does it help the company? It calculates the present value of the future earnings of the employees. Just to give you one idea, what is the return on human resources value in percentage? In 2008 it was 4.7, in 2009 it was 5.9. That means to say, in every figure is reported in everything in rupees crores. So, this is the percentage which you are really getting. So, if you see, there has been a steady increase in the return on human resources value also. The brand evaluation model, again methodology for valuing the brand. So, what does Infosys do? Determines the brand profits by eliminating non-brand profits, restate historical profits at present day values, then provide for remuneration of capital to be used for purpose other than promotion of brand, adjust for taxes, determine the brand strength. Then the economic value added again given to you in this method. Then the global delivery model, what does it tell you? So, this is what I just mentioned to you, and the book also gives you this strategy of this global delivery model and how it is done, client location, offshore development centers, what does the company do, then what does it really, what does the company really do? It is if you really see, the white paper of Infosys tells how Infosys wants to win in the flat world. So, it gives you this modular global sourcing. What is it? It is a set of decision frameworks and planning activities designed to help you make sound strategic sourcing decisions and achieve high returns on your IT and business process investments. So, then the some indicators on modular global outsourcing with respect to traditional monolithic IT, then the modular approach given by this slide, then what is the fundamental shift required in a flat world. So, if you really see cost as a fuel for growth, loyalty to through foster investigation innovation, then making money from information, then winning in the turns. So, what is the services offered by Infosys? These are the services starting from consulting down to packaged application services. Then what are the industries that are catered to by Infosys? Goes from aerospace down to the utility services. Then what are the major clients given here? All Fortune 500 companies, name it, whether it is the Reebok or the Verizon or the Bell Canada or the British Telecom. Then what is the PSPD model given to you in the book, also listed again in the particular in this slide. So, the PSPD model tells how does the company go about with respect to quality, people and transparency, then comes with the predictability, sustainability, profitability, de-risking. Then the questions which are asked in the case with respect to the appropriateness of the models. So, if you really see, after making all this, you answer the questions. So, this is the way you should really address the issues. So, you have got full information, and with this full information at your command, you are in a better position to answer the issues that are listed in the case. So, two issues are taken up concurrently, that is first and the second issues, appropriateness of the models and the shift in technological business. So, what is the type of this thing which they come out with? So, they say the company, in order to maintain low cost advantage, has opened offices in Czech Republic, Mauritius, Poland, Philippines, Thailand and Mexico, invested in developing training centers, improved quality capabilities, then consultancy established to provide high end services in value chain, then has hedged currency for more predictability of revenues, risk management. So, in other words, the company is really taking care to see that it is not outwitted in this marketplace. Then looks at the generic strategies, the next slide. Then the grand strategies the students have analyzed with respect to the Ansof's matrix. Then the market penetration strategies which the company has adopted. Then the The students have given the revenue breakup by geography. Similarly, they have addressed the other issues by after this revenue breakup. They have gone to issues 1 and 2 with respect to concentration, where it is coming from. 90% coming from American and European nations. So, this is company is looking at vertical integration, then innovation, that is set labs, which has been set up in Infosys. Then strategy, whether it is successful or not. So, there is a recommendation which is made. This is a group recommendation. If you really see, always a buy, most favored company by investor, underperformer rating by most brokerages to be seen cautiously. So, recommendation is consolidation and strategy acquisition. So, just consolidate yourself in the market and before acquiring a company. So, what is the type of these things which you are seeing? So, this is reflecting by the global ambitions of Infosys trying to acquire industries. So, this is with respect to both the vertical and industry based, looking at broadening the thing. Then the students address the third issue. So, where is it? The company is now looking at other markets, not just the US market. So, the likely impact, according to the group, is there is going to be some negative impact in short to medium term. So, given the BCG matrix with respect to Infosys, that is USCA, then given the benchmark, then should Infosys go in for branded products? Only one branded product is there of Infosys, that is Finacle. So, it may be better. So, what do they say? So, the students say that productivity should be enhanced, that is it may be better to look at more number of products added to this. So, what are the steps suggested? Inorganic growth through mergers and acquisitions, then sectors with high growth to be tapped immediately. Then for software product development, should employ a process based on best practices of agile methodology and CMM level 5 quality. Then for mechanical products, lean methodology based solutions in knowledge based engineering should be developed to shorten time to market. Should Infosys aim for distinctive competence? So, there is what does it tell you? According to the group, the factors where Infosys can have a competitive advantage or by effectively integrating on-site and offshore execution capabilities, then increase scale and breadth of service offerings, then provide industry expertise to clients' business solutions, then attract and retain high quality technology professionals, then maintain financial strength to make strategic investments in human resources and physical infrastructure through business cycles. So, what does the future hold? Consulting holds a very promising future for Infosys. Should look at consulting as one of the very possible options. So, this is the way a case like this Infosys has been analyzed by two students, which I brought out for you to know how you could analyze a case. So, this is an example of case analysis. The case that is taken up for analysis was the one which is listed, or which is the one which is given in strategic management on Infosys. How you should analyze, I have gone through. We will continue in the next class. Thank you.